We thought, our house price was going up, my stock portfolio was rising at 11% per year, my home was appreciating at double digits, and so from people's paychecks, they weren't saving hardly any of that because they thought on paper they kept getting wealthier because of their investments. When in reality, if they knew that that was a bubble and those things were going to crash, they would have been, out of their paycheck, they would have been saving a lot more. And so that's part of the perversity of what happens during this Fed-induced credit boom. Okay, so that's the Austrian story of what happened. And so in particular, you had things during this recent boom. You had resources flowing into the housing sector. You had too many resources flowing into the financial sector. I'm sure you're all aware of all these exotic derivatives. They had mortgage-backed securities and things like that. That these so-called quants on Wall Street were devising all these products that were supposed to diversify risk and things like that. And you had all this talent, really talented people with PhDs in physics and math coming out, and they were going to Wall Street, working for these firms, earning ridiculous amounts of money. Now that we know in retrospect that what they were doing wasn't adding value at all. Okay, so the question now is, okay, given there was this artificial boom period, what needs to happen? And the answer is obvious. Well, you need to allow interest rates to rise back up to the proper level so people can, so those market signals can mean something again, that interest rate can tell you how scarce is capital, or what's the true price of liquidity. That price means something. People need to know that. That helps people arrange their decisions. And you need workers who were employed in the housing sector. They need to go somewhere else. And all these people that were in the financial sector, a lot of them, they need to go somewhere else because it's, the state of the American and the world economy as of 2005, early 2006, that was unsustainable. And so government policies that try to freeze reality and keep the economy in that configuration, they're harmful because the economy, it can't stay like that. And so just trying to, what they're really doing is they're trying to reflate the bubble. Okay, so it's perverse that the typical government response, of course, is the exact opposite of what I'm saying. What does the government do? The Federal Reserve, after the crisis set in, and again, this was true back in the Depression and it's true today, they started cutting interest rates. And in fact, in the U.S., they've got interest rates basically down to zero, and that's not even enough for them. Now there's plenty of academics saying, okay, well, the Fed can't push actual interest rates below zero because no one's going to lend $100 to get 95 back next year. And so now, so you would think that, okay, they might have thought, okay, since we've pushed interest rates down to zero and nothing's getting better, maybe we should rethink our strategy. But that's not what they're doing. They're saying, okay, well, the problem is real interest rates, meaning inflation-adjusted interest rates, should be around -5%. But we can't set actual nominal interest rates at -5%. So here's what we'll do. We'll keep actual nominal rates at 0%, and we'll promise people 5% inflation next year. So that in real terms, it's a -5% real interest rate. And so the correct thing is Ben Bernanke should promise people that he's going to flood the market with money next year. Right? And that's the recommendation of people like Paul Krugman from the left, and then people like Greg Mankiw, if you know that name, from the so-called right. So I mean, this wide spectrum of opinion in terms of respectable media opinion, they all agree that what the Fed needs to do is promise to dump more green pieces of paper in the U.S. economy, and that's the way to fix things. All right. So from the perspective of what I've been telling you tonight, that's the exact wrong thing to do. It was low interest rates that got us into this mess. A very sort of glib way to put it is, if the problem that we're in is because Americans overconsumed and the rest of the world overconsumed during the housing boom, the way you fix that is people need to save more now. They need to cut their consumption so to replenish, all the sectors that were starved, as it were, during the boom period. Because again, during the boom, certain sectors expanded, like housing and financial services, at the expense of other ones. Because when Greenspan cut interest rates, the economy didn't really get richer. People thought they were richer. They went out and started spending and buying imports from China and things like that, but they weren't really richer. So something has to give. And the idea is what it had to give was the capital structure of the United States and other countries that participated in this boom. And so the way you fix that, again, is people have to cut back on their consumption. They lived above their means for many years, and now the solution is to live below their means. And actually, people around the world are trying to do that. I'm more familiar, of course, with the U.S. figures, but Americans, their savings rate was actually slightly negative for a while there, and now it's back up to, I think it's around 5%. And so that's a good thing. And left to their own devices, so they're doing the right thing. American households know that, okay, oh my gosh, we're much poorer than we thought we were because our house just plummeted, whatever it is, 15, 20%. Our stock portfolio just dropped 40% in about a year, and so they're not going out to eat as much. All sorts of sort of leisure activities, those sectors are all being hurt very badly because most U.S. households aren't spending as much. And that's the appropriate thing. That's what needs to happen. And that's left to their own devices. The economy would fix itself. But the government, of course, isn't letting that happen. So it's counteracting all that, and more so because the government's now running one of the biggest deficits in U.S. history in terms of the size of the economy. So, it's perverse that the government is counteracting all of the normal reactions that are the correct things to do at the household level. Okay, so let me just try to relate a little bit, to tie this back to the Great Depression again, to see that this is the same sort of thing that happened. So you had this unsustainable credit boom in the late 1920s. The stock market crashes in 29. So again, the conventional history books say that Herbert Hoover did absolutely nothing. He just stood back and wanted the economy to fix itself, and that's not true. What Hoover did, he called in all the big business leaders, and he told them, and he did this right away, right after the stock market crashed, within a few weeks. He calls them in and he says, I want you to keep wage rates at the same level. All right, so I don't want you to cut wage rates because I know, you guys thinking individually, it makes sense that your sales are falling, consumers are scared, they're not spending as much, and your natural inclination would be to start laying people off and cutting their pay. But if you start doing that, it's going to cause this vicious downward cycle. And so don't do that. Keep your wage rates the same, because the cliche is you have to pay the worker enough to buy back the product. Right? So that was the mantra. And this was unusual. And in the book, I give evidence of this, that Hoover himself in his memoirs, patted himself on the back saying how he had broken ranks with all previous U.S. presidents, that during downturns before 1929, it really was the case that the U.S. federal government basically sat back and did nothing and just let the recession run its course. And so Hoover was thinking, I'm going to be the first one to really fight this thing and to stand up for the working man. Right? He says this in his memoirs. He said it in his speeches at the time. And also you can go to the official statistics to see what happened to wage rates during the 1930s downturn compared to earlier ones. And so it's true that wage rates did not fall very much from 1929 to like 1933. But at the same time, you had unemployment went up to the highest it's ever been in the United States history. And that's not a coincidence. That's because of Hoover's allegedly compassionate policy. Right, so on the surface of it, it kind of makes sense. And if you talk to someone who hasn't studied economics much, it does seem plausible that, in the middle of a severe recession, the last thing in the world you want is businesses to start laying people off and cutting their pay, because then they can't spend the money on the products and it's just going to spiral downward into oblivion. But what happened in the 1930s is prices in general kept falling. And it's a little bit complicated. It had to do with the fact that people were scared, and so they were taking their money out of the banking system. And there was what's called a fractional reserve banking system. So the idea is if you put $100 in the bank, they didn't just take that and go put it in a vault somewhere with your name on it. They only kept about $10 in cash in the vault, and then they would loan out the $90 to somebody else who wanted to take a loan from the bank and go buy something. And so in terms of the overall money supply, the money that the public had to spend on things, cash and also their checking account balances, if a lot of people get scared and start pulling their money out of the bank, then the overall money supply shrinks because of that fractional reserve nature, right? That if you take out 100 in cash, the bank has to call in loans from other people in order to get the cash to pay you off, if you're following me. Okay, so what happened from 29 to 33 is you had all these bank runs, all these banking panics, and so the overall money supply contracted by about a third, by about 33%. And so because of that, and also because people just in general were scared, they weren't spending as much, prices were falling. They fell about a little over 10% a year for certain periods there. Okay, so you had pretty severe falling prices, but at the same time, because of the president and unions and so forth, wage rates weren't allowed to fall. So if you were a worker and you kept your job during the onset of the Depression, you kept getting richer as time passed because you kept getting the same paycheck. You got paid the same number of